Ever wonder about real estate but feel frozen or where to start? We can help you narrow down your market with these simple indicators. Welcome to Real Estate Jefas. This is Lindsay and my co-host.
Violeta, hi.
We're going to talk about how to narrow down your market. And this is a question that I think every rookie and every real estate investor posits themselves because we have over 3,000 markets in all of the United States. And if you are living in a high cost of living area like New York, Los Angeles, Texas, whatever, then it takes a lot of money to break down into real estate. You would have to put at least 20% down. So when we're looking at markets, you have to know that what is it that you want to accomplish? Are you investing for cash flow? Are you investing for appreciation? I think Violetta and we can tell you that we invest for cash flow. And that's an individual reason to invest. So you just really have to talk to yourself and find out what the goal of your investments are for.
The big question that a lot of people have and that I get will be like, oh, how do I find where to invest in? Because I live in whatever and the houses over here are like really high and it's out of my reach to invest in this market that's right here by me. So how do I go look for a market? Where do I go? Especially when they find out both me and Lynn, we are out of state investors. So it's like, how did we find these markets? How do I know that it's a good market? And so that's what we're going to be talking about today and help you how to find a market that you can invest in.
Yeah. One of the first indicators that I look at is the population of the city. So if your population in at the market that you're looking at, it's below 50,000 people, then you're probably going to have a hard time renting out the houses to those people. So the bigger the population and also the rate of the population increasing. So if there's a lot of resources that you can tap in here, you can do a simple Google search. You can ask ChatGPT. You can ask Grow, Google Gemini, or you can ask Zillow, what is the average population growth of this city? And what is the population at right now? That would be indicator number one. For me, indicator number two, and this is something that I learned over the years, is average house income. So when you look at an average house income, you would be able to see how strong the job market would be in that city. So for my particular standard, 40,000 and above would be a good market indicator, which would be like majority of the people there fall between just over poverty line. So you would be able to discern what kind of neighborhood that is because you would learn that there are neighborhoods class type A, B, C, and D. And exactly what it sounds like, it's what it means. So if you're looking at a type A neighborhood, that means the homes are more like newer, renovated. The school system is like, mostly renowned.
Mhm.
And also there's less crime in a type A neighborhood, but
Mhm.
it comes with a ticket price. Houses are
Mhm.
expensive, taxes are higher. You have even municipal taxes or school taxes that might like affect your investments there.
Yeah.
Then you have your type B neighborhoods, which like you would probably see a lot of blue collar people work in these neighborhoods in which they, work at jobs, they get paychecks, their houses are not as expensive, they're not as newer, they're probably a little bit older, they've probably been there for a long time, there's probably little children in the house and so
Mhm.
forth, a little more crime, a little less nice public schools and things like that. And then C and D follow more so in the crime rate and more poverty per se.
Understanding these classes will help you figure out like what you can expect. Because a lot of times when people think about real estate investing, you'll see these investors and they're talking about these, big properties that they have and that they're investing in like mostly class A neighborhoods because a lot of the bigger investors for the most part they've already moved on to like bigger type of investments. So when you see that they are investing in the like type A markets, it kind of makes it seem like it's unachievable. And then even with class B properties. That one is a little bit more achievable, but it's now with the house prices and stuff, these are the suburban neighborhoods. It still can be a little bit unachievable because you still need like a pretty decent down payment to get into these properties. And so you're kind of left more with class C that is a little bit more doable, but you also have a little bit higher risk because these are usually a little bit more beat down. Or with Lynn, it's more probably categorized with more class D because she's doing full rehab projects on those. Uh, my duplexes are considered class C because they're lower income neighborhoods, still working class, but these people are living more like paycheck to paycheck. The properties are older, like, my properties were built like in the 90s, whatever. So you have to keep that into account. So understanding um, the types of classes of properties will start giving you an idea of what to expect. Because a class A, you don't expect to do like a lot of maintenance or full rehab for per se, unless you find a diamond in the rough in a really cool neighborhood. You get lucky with one of those. But for the most part, your more rehab and stuff is going to be in class C, possibly B, depending, on who had the property. Because if you're taking them from like boomers or something, more than likely they didn't take care of the house.
This is really why it's individualized. When people ask us, like, what is the best market to invest at? It's really an individualized plan for you because a lot of the things that indicators that will tell you, they will tell you how to feel about an area. But in reality, you need to assess your risk tolerance and see what gives more for you. Like, would you rather have a type A neighborhood where you're investing, where cash flow is not even net, think maybe you're breaking even, but you are willing to give that up for the appreciation, for less turnover, for a better tenant pool, then that is the kind of risk tolerance that you have. If
Yeah.
you are more of like, I would work on it. Like, for example, I work in my rehabs and I put a lot of work on them and I rehab them and then I rent them out and I get the money out. It's active work and my tenant pool, it's cash flow driven as well. So the amount of work that I put in reflects on the amount of money I get back. So this is more of an active, and I'm okay with that less risk tolerance than you would be looking at neighborhoods like C type neighborhoods that would be on the better areas of like leaning towards B type neighborhoods.
That's the number one thing to understand what your financial goals are. When do you want to accomplish this goal and what can you do now, right? Like if you're like super busy and everything like that and have a full family and all that stuff and you might not have enough time to go do rehab properties and maybe you're okay with not having the cash flow right now because you don't plan to like retire for another 20 years. So you're okay with just more appreciation and, in the future getting that cash flow. So you're investing that way. But for me, I am choosing cash flow now because I want to be more work optional and be able to buy back most of my time now. It's an extra income. And so that's why I'm focused on more cash flow and I chose class C properties because it's more achievable to me to be able to get the down payment and get into these properties than investing in an A or B neighborhood. Even when I had like my job and everything, like I was single, I could have, but I chose like, no, this is my personal goal.
If you're confused about like what is the difference between a type A, B, or C neighborhood, there's a couple of resources that I use. I go to a website called niche.com. And we're going to link it on the episode on a podcast as well. And then you are able to type in the city that you're looking at, even by zip code. So on a
Right.
zip code, it would have a breakdown of like public school systems, and what is the crime, what is the population looking like, what is the average of the population, like the average age of the population, different statistics like that. It'll give you an overall score: A plus, A minus, B plus, B minus. C plus. Another website to look at is Neighborhood Scout, and it's basically the same. It will tell you like crime rate and then also a little more details about the area. And talking about more indicators, you would have to look at the job growth because if there's no jobs in the city that you're investing, then most likely it's going to be resulting in a lower quality tenant pool.
Mhm.
So business that are coming into the particular market that you're looking at. So, for example, in Temple and Taylor, Texas, there's some manufacturer company coming into those
Mhm.
cities. And I know a lot of people that are investing heavily there in midterm rentals because they're going to need a lot of construction workers for the next 2 years. So there is a lot of demand
Mhm.
in that city. And the only way that you can tap into that is by knowing, like by staying put into that city news and
Mhm.
being local to the news and being actively and proactively looking information like that. In my
Yeah.
city, in Gary, for example, there's a casino built and that drove a lot of people coming into the area now. Now there's going to be a convention center being built just down the street from the casino. These are businesses that are going to require a lot of labor and may take 1 to 2 years of people that move in there, and that's going to create a lot of jobs.
Yeah, that's one thing you should be tracking when you're looking at a potential market, what the average or median salary is for the people there is a good idea to understand that because a lot of times I'll see like people get into a market and they expect that they are going to get, for example, one area that you could also look for like rental market is Zillow. They have a thing on there that gives you kind of like the average of what to expect for rents. And there's another one like rent and apartments.com or whatever. Like you could look up whatever. But on there it'll say that the market rent is like 1200 or 1100 for a two-bedroom, one bath apartment or house or whatever. But then you look at the job market and that's basically at the very top. Like you're going to be stretching your tenants pretty thin and I don't like to even though the rental market says 1100, I stay at like 895. 895, 925 because I don't want to be at the top because the job market shows that they're not making that much per year, right? Their salary. So how can I expect them to pay that much? Like I'm going to be struggling to get tenants and keep them and probably they're not going to be able to pay rent or whatever. So you want to understand that as well because you might think like, "Oh, I could get 1200, 1100." But you need to be realistic, which is why it's so important to look at these things and also understand what's coming in because I know near me where I'm at, I know there's a lot of projects that are starting to pop up. And so I'm debating this like, ooh, do I want to get into this market because I know jobs are coming this way. Now, I'm still in the research phase of that, but there's also manufacturer company. They're building a factory. And so things like that, maybe they're building office buildings, whatever. All that stuff is what you have to kind of keep track of to see if it could be a potential market to get into.
You need to know the market that you're going to pick. So regardless if you're looking on your backyard or looking on a place that it's out of state, you need to find out about the market. Maybe it could be a place that you lived when you were a kid and then you left, but you have some knowledge of that market, or you went to college there and you know there's a big college driven rentals in that market, or your family member lives there. So you're visiting that market. I feel that because you have connection to that market and you have some knowledge already, this is your starting point, right? Look at it twice. Look at the job in that market. Look at the household income in the market. Look at the population growth in the market. So these are places that you already know have a connection to, regardless if it's emotional, familial, or whatever it is. You already need like have some kind of knowledge on the market. So start from there because you may not know, but you already have connection to that.
Yeah. Yeah. For example, my husband's family is in Florida, so every time I went over there, I was like, "Well, we come here all the time. Like, maybe I should invest in maybe an Airbnb over here because that is a good location." But then I was like, maybe I'll wait because at this time it was all the hurricanes and all the insurance things that was happening. And matter of fact, my in-laws managed to get like a manufactured home for $1 because whoever owned it, that manufactured home had a little bit damage, right? A little bit damage to the roof and broken windows from the hurricane. And she freaked out. And so she took off and was like, I'm going back. I forget where she was from, and left and sold their the manufactured home for $1, including all the furniture and stuff. Now it's not like a fancy manufactured home, but it's still like they got a house for a
Mhm.
dollar because of that. This was a 55 plus neighborhood. So I was like, but there's stuff like that out there. I know down the street they were selling one for $100 because they just want to get out because they don't want to have to deal with fixing up manufacturer. So that's why I was like, nah, you know what? I'll wait.
Yeah, and that's something that you're gonna have to set your mind to. There is a lot of markets out here, and there is a lot of people thriving and failing in that market. So you need to make sure you network with the people that if you narrow that a market, let's say Florida, let's say Texas, let's say Los Angeles, then you get around people that are already doing that successfully. And that is the only way you're going to be able to network with those people. And then if you ever met a real estate investor, they love to talk about real estate.
Hmm.
They love to talk about real estate. So if you get around these people and provide some value for them or just ask them to lunch or ask them to have a cup of coffee, they most likely will give you their time.
Yeah.
If they don't give you their time, then you move on to the next person. Because if you reach out to anybody via social media, I'm sure you reach out to Willetta, you reach out to me, you reach out to other people that are investing on these markets, they would most likely in at least a referral of who you can talk to, who you can see if this market would work out. And Florida, for example, taxes and insurance, mostly insurance is a big thing right now, but
Hmm.
there are investors out there still investing successfully. Maybe they're not doing long-term rentals. Maybe they're doing co-living. Maybe they're doing Airbnb. Maybe they're doing BRRRR. Maybe they're doing fix and flip. But they're triggering, like they're moving from like what their normal technique is of like just having rentals just to accommodate the market because they see the potential of staying in the market, right? So
Hmm.
don't feel because it's hard for you that, it's overwhelming, all of this information that we're throwing at you, that you can't do it. Just get out on the people that find the solutions versus look at the problems. And that's where you're going to become once you're a real estate investor. You're going to go through the solution because problems are going to arise.
Once you decide or maybe are interested in a certain market, like there's like you said, like find where these investors are, and I know you're like thinking, okay, well, it's an out of state, like how am I going to network? Well, you have Facebook groups. Lynn, she literally just, I think you said it was on YouTube or something that you
Mhm.
looked up if there was any videos there, and I've actually done that as well. And usually, like a realtor or maybe an investor pops up, and that's how you ended up finding the group for the market that you're in. And you could do Facebook groups. That's how I did the one where I'm at. I was just in a general real estate group. The way I found my market was that I was in a real estate investors group for the military. And then I was like, well, I got some cash. I want to invest it into like multifamily, but like I don't know what kind of markets are there. And it's just so happened to be that somebody that was in my field in the military, and we were already in contact, which is funny because of networking for our field. And he saw me in that group because he happened to be in that group. He's like, hey, I'm investing in Milwaukee in this area and stuff. So, and I'm doing good or whatever. So then he ended up guiding me to buy my first property there, and telling me about the market and blah blah blah, and guided me and stuff like that. And so now I'm in that market because of that person. And you had a similar thing too, where you were kind of looking at that and they put you on the market that you're currently in.
Yeah.
So that's one way that you could network as well.
Yeah, you can definitely network online. You can network in person. If you're investing in your backyard, go to a real estate meetup, go to your local REI groups. Try to find maybe in your family. Like I remember calling my family members and saying like, "Oh, does anybody actually invest in real estate here? Like, what is going on. But yeah, if put yourself out there, and then even if you think you're a shy introverted person, because I consider myself that way as well, then go online, go and find the
Mhm.
people that you can talk to that are growing their media business. They're growing on YouTube. They're growing on Instagram. You're probably gonna get a personalized answer rather than a broad answer as well. And follow our podcast, obviously. Continue to view our episodes and support because we're trying to bring important information, useful information for you to, start your real estate business.
It's intimidating at first. I know I was kind of like nervous to get into this market that I've never been to, and I still haven't even been. I still have not set foot in this market. But, one of the good things is that we have technology at our fingertips. Like you can literally go on Google, look up this address, and literally walk, virtually walk the whole neighborhood. I've gone through there and just took a stroll around the neighborhood through Google, to see how it is because, just one little thing that I wanted to mention was like whenever you are in these class C and class D neighborhoods, you have to keep in mind with these types, each neighborhood can be separate than the other. So one street can be pretty good, a good established like neighborhood, and then two streets down, it might be a little bit more higher crime or whatever. So
Yeah.
they're their own little market. And that's what one thing I had to learn that, this street that I'm investing in, that neighborhood, it's a family oriented neighborhood and they keep each other. And matter of fact, I had when I was looking at one property, I didn't end up buying it, but the neighbor was very concerned because she wanted to make sure that whoever bought that property didn't rent out to like bad tenants that are going to bring crime because that was an old established neighborhood. And so he talked to her. It was pretty. I didn't end up buying it though because it had a lot of issues, but hopefully whoever bought it didn't bring crime to that neighborhood.
Pick a market that if you're gonna invest for appreciation for cash flow, it's gonna work for you. But also, I would advise you never to pick a market when you're in the negative. So, because there are so many things that are gonna come up with real estate, something is gonna break, some tenants gonna have a problem, something's gonna back up. Just regular living things day to day. If you live in a house, there's things that go breaking down on you, even though they're new. So
Mhm.
if you are in the negative, you're paying money monthly to keep that rental afloat, then you're going to be at a loss when that thing that breaks down comes on. So
Mhm.
be mindful that you are not least in the negative every single month when you're gonna have the rental.
That's true. I would not recommend definitely because you'll get investors and I've had it at the very beginning. I've had some investors that are like, "Well, don't sell that house because, it's going to appreciate in the future and blah blah blah." And both in my second house, because I wasn't in the real estate investor mindset, so I bought a house that I wanted to have as an investment property, but it wasn't going to be a good investment property because I bought it for me, basically. So then I was paying out of pocket for the property manager. And I remember getting advice like, "Hey, don't sell it. You're gonna the appreciation or whatever." I was like, "Yeah, but I don't want another bill right now. That's not what I want." And same thing with the California house. The rent that I would have gotten from that, not gonna I was gonna be again paying out of pocket. So then if I wouldn't have sold the second house, I was already, paying money out of that, being in the negative, and then I would have had another house paying in the negative, all because I was like, "Oh, the future appreciation and blah, blah, blah," especially in California. Like, it was really hard to let go of that house because I was like, I know houses in California, like, you don't wanna get rid of them, but I don't wanna have that risk either of, almost 4,000 mortgage, and I'm coming over here to Texas and, the plan was to, like, not really work for a few months or whatever, and then if I didn't have a tenant or something broke, I have to pay that out of pocket. So I got rid of both of those and then moved into a market that was going to cash flow instead. So don't get stuck with some of this real estate advice that tell you like, oh, think of the future. Like, no, think of your own goals, your own plans, and what you can do right now. And like you mentioned, like, is it putting you at risk right now?
And then you have to start thinking it of as a business too. You're building wealth for your family, but it's at the end of the day, it is a business. So you look at it, don't get attached emotionally to a house. It is, it's going to take a lot of work to take a lot of effort. And it's really easy to assign feelings to a particular structure, but
Yeah.
it has to work out for you number wise. It has to work out for your future. So you need to work on that detachment as well.
Yeah, that was definitely something I had to learn, which is why my second property was a house for me, not for investment. And and same thing with the third house. So, but I learned now, and yeah, sometimes you have to remember to detach emotionally from these things, especially when you're looking at rehab properties or class C and D neighborhoods, because you're thinking like, oh no, like I wouldn't live there or whatever, but it's an investment property, and the goal is to fix it up.
Yes. So if you like this episode, please like and subscribe on YouTube. We are also on Spotify. If you would like to leave a comment, please leave a comment. Tell us what market you're in, where market you're investing or thinking about investing. And
All right, well, that's it for this episode, and we will see you in the next one. Bye.
bye, guys.